Good day, viewers. Welcome back to our channel, Eskemoz. Now, I know what you're thinking. Insurance? That sounds about as exciting as watching paint dry. And you'd be right, if we were talking about your standard car insurance policy. But today, we're diving headfirst into a world of insurance claims so monumental, so eye-poppingly huge, that they'd make even the most jaded accountant gasp. With all the different calamities and unforeseen events that happen around the world, insurance companies play a vital role in economic recovery. They are the silent heroes, stepping in to help individuals and businesses piece their lives back together when disaster strikes. And sometimes, those disasters are so big, so utterly catastrophic, that the payouts reach astronomical levels. Today, we're dipping into some of the most eye-opening insurance payouts in history. From natural disasters that reshaped continents to acts of terrorism that shook the world, we'll be exploring the events that led to these record-breaking claims. So buckle up, viewers, because things are about to get interesting. Let's get started. Our first stop takes us back to August 14th, 2003, when a massive power outage plunged a large swath of the northeastern United States and Ontario, Canada, into darkness. This wasn't just your average neighborhood blackout, folks. We're talking about 55 million people suddenly left without electricity. A stark reminder of how reliant we are on a functioning power grid. Imagine, traffic lights go dark, subways grind to a halt, businesses are forced to close, and millions are left sweating in the summer heat. The economic impact was nothing short of staggering, with estimates ranging from $4 billion to $10 billion, making it one of the costliest blackouts in North American history. But amidst the chaos and disruption, insurance companies stepped up, paying out an estimated $1 billion in claims. These payouts covered everything from spoiled food and powerless refrigerators to business interruption losses. It was a stark reminder that sometimes even the most basic necessities we take for granted, like electricity, can vanish in an instant, and insurance is there to help pick up the pieces. Next up, we're heading to the Gulf Coast, where Hurricane Ike unleashed its fury in September 2008. This powerful Category 2 hurricane ripped through the Caribbean, leaving a trail of destruction in Cuba before slamming into the Texas coast. Galveston Island bore the brunt of Ike's wrath, with a devastating storm surge that flooded homes and businesses. The images from Hurricane Ike were truly heartbreaking. Homes reduced to rubble, communities submerged in water, and lives upended. The storm caused an estimated $38 billion in damages in the U.S. alone, making it the third costliest hurricane in the country's history at that time. And as you might expect, the insurance industry was inundated with claims. Total insured losses from Hurricane Ike topped a staggering $19 billion, marking one of the largest payouts for a natural disaster in U.S. history. This event underscored the vital role insurance plays in helping communities rebuild after such catastrophic events. Now let's shift gears and talk about earthquakes. In 1994, the Northridge Earthquake, a magnitude 6.7 tremor, jolted Los Angeles awake, sending shockwaves through the region. This wasn't just a gentle rumble, folks. It was a violent, destructive force that toppled buildings, cracked highways, and ignited fires. The Northridge Earthquake left a trail of destruction in its wake. Collapsed freeways, damaged homes, and disrupted businesses became a common sight. The economic impact was significant, with losses estimated to be around $44 billion, making it one of the costliest earthquakes in U.S. history. As with any major disaster, insurance companies played a crucial role in the recovery process. The Northridge Earthquake resulted in a massive $20 billion in insurance payouts, helping individuals and businesses rebuild their lives and livelihoods. It was a stark reminder that the ground beneath our feet, seemingly stable, can turn treacherous in an instant, and insurance provides a crucial safety net. Let's rewind the clock to 1992, when Hurricane Andrew, a ferocious Category 5 storm, roared through the Bahamas, Florida, and Louisiana, leaving a trail of unprecedented destruction in its wake. This wasn't just a storm. It was a monstrous force of nature that reshaped the landscape and left communities reeling. Hurricane Andrew was a stark reminder of the raw power of Mother Nature. Homes were reduced to splinters, businesses were flattened, and entire neighborhoods were left unrecognizable. The storm caused a staggering $47.8 billion in damages in 2022 USD, making it, at the time, the costliest hurricane in U.S. history. The insurance industry faced a deluge of claims in the wake of Andrew's wrath. In total, insurance payouts reached $15.5 billion, a record at the time for a natural disaster. These payouts were essential in helping communities rebuild and recover from the devastating impact of the storm. Our journey now takes us to Japan, where on March 11, 2011, a monstrous earthquake, the fourth largest ever recorded, shook the island nation to its core. But the earthquake itself was just the beginning. Minutes later, a massive tsunami, a wall of water exceeding 130 feet in height, surged inland, engulfing entire coastal communities. The images from the Tohoku earthquake and tsunami are seared into our collective memory. Buildings swallowed by the relentless waves, cars tossed about like toys, and the sheer scale of the devastation beyond comprehension. The event claimed over 15,000 lives and left hundreds of thousands homeless. The economic impact of the Tohoku disaster was colossal, with damages estimated at over $360 billion. Insurance payouts reached a staggering $35 billion, the largest ever for an earthquake. This event highlighted the crucial role of insurance in providing financial support for rebuilding and recovery on a national scale. Let's fast forward to October 2012 when Hurricane Sandy, a sprawling and powerful storm, slammed into the east coast of the United States. This wasn't just a hurricane, it was a hybrid monster that combined the forces of a hurricane, a nor'easter, and a full moon, resulting in a devastating storm surge that inundated coastal areas. Hurricane Sandy's impact was widespread and devastating. From New York City to Atlantic City, the storm left a trail of flooded subways, downed power lines, and damaged homes. The economic losses were estimated at around $78.7 billion, making it one of the costliest hurricanes in U.S. history. The insurance industry faced a surge in claims as a result of Sandy's wrath. Total insured losses reached $26 billion, highlighting the significant role insurance plays in helping individuals and businesses recover from such large-scale events. Now we delve into a somber chapter in human history, the September 11th attacks. On this day, terrorists hijacked 4 planes, crashing them into the World Trade Center towers, the Pentagon, and a field in Pennsylvania. The world watched in horror as the Twin Towers, symbols of American capitalism and ingenuity, crumbled before our eyes. The September 11th attacks left an indelible scar on the American psyche. The loss of life was immense, with nearly 3,000 people perishing in the attacks. Beyond the human toll, the economic impact was staggering, affecting various sectors from airlines to the insurance industry. The insurance industry faced an unprecedented challenge in the aftermath of the September 11th attacks. Total insured losses reached an estimated $40 billion, making it one of the largest insurance payouts in history. These payouts covered everything from property damage and business interruption to liability claims and life insurance. Let's shift our focus to the world of finance, where, in 2008, the collapse of Lehman Brothers, a global financial services firm, sent shockwaves through the global economy. This wasn't just a bank going under, it was a seismic event that triggered a financial crisis, exposing the fragility of the interconnected global financial system. Lehman Brothers' downfall was a stark reminder of the risks inherent in the financial world. The company's collapse triggered a domino effect, leading to a credit crunch, a stock market crash, and a global recession. The economic fallout was immense, affecting businesses and individuals worldwide. While not a natural disaster or a terrorist attack, the collapse of Lehman Brothers triggered a different kind of catastrophe, a financial one. The insurance industry played a significant role in mitigating the fallout, covering losses related to credit default swaps and other financial instruments. The exact figure of insurance payouts related to Lehman's collapse is difficult to pinpoint, but it undoubtedly contributed to stabilizing the financial system during a turbulent period. Back to the realm of natural disasters, 2005 was a year that etched itself into the history books for its sheer hurricane activity. Hurricane Katrina, Rita, and Wilma, a trio of powerful storms, unleashed their fury on the Gulf Coast and southeastern United States, leaving a trail of destruction and despair in their wake. Each storm brought its own unique brand of devastation. Katrina, the most infamous of the three, slammed into New Orleans, breaching levees and flooding the city. Rita and Wilma followed, inflicting further damage on already battered communities. The images from these hurricanes were heartbreaking: flooded homes, displaced families, and the sheer scale of the destruction almost too much to bear. The combined impact of these three hurricanes was colossal, resulting in an estimated $215.8 billion in damages in 2022 USD. The insurance industry faced a deluge of claims, with total insured losses exceeding $60 billion. This hurricane season served as a stark reminder of the vulnerability of coastal communities to the destructive power of nature. Our final stop takes us back to the tumultuous year of 2008, when a global financial crisis gripped the world. This wasn't just a blip in the market, it was a full-blown economic meltdown, triggered by a complex web of factors, including the bursting of the U.S. housing bubble, excessive risk-taking by financial institutions, and a lack of regulatory oversight. The 2008 financial crisis was a stark reminder of the interconnectedness of the global economy. Banks teetered on the brink of collapse, credit markets froze, and businesses struggled to stay afloat. The impact was felt worldwide, leading to job losses, home foreclosures, and a general sense of economic uncertainty. The insurance industry played a crucial, albeit complex, role in the 2008 financial crisis. While the exact figures are difficult to pin down, it's estimated that insurance payouts related to the crisis exceeded $1 trillion. These payouts covered a wide range of areas, including credit default swaps, bond insurance, and other financial instruments. That wraps up our list for today, viewers. We've journeyed through some of the most significant and costly insurance payouts in history, witnessing the aftermath of natural disasters, acts of terrorism, and financial meltdowns. These events serve as a stark reminder of the unpredictable nature of life and the importance of being prepared for the unexpected. It's a huge reminder that insurance claims play a crucial role in helping individuals and businesses recover from catastrophic events. Insurance provides a safety net, a financial cushion that can help people rebuild their lives and livelihoods when disaster strikes. It's a testament to the power of collective responsibility and the importance of mitigating risk in an increasingly uncertain world. We hope you found this video insightful. Don't forget to subscribe to our channel Eskemoz for more eye-opening explorations into the world of finance, business, and beyond. See you in the next one.